Hi, welcome back. Hey, this is Neil, and we're in one of the last sessions of a strategic management accounting course, and that is incentives for responsibility centers. And I want to show you a few slides to begin with, but these are more big picture slides, and then we'll get into the good stuff. So, what is the big picture? As we've taken you through this course, we've actually looked at the bottom-up approach, activity-based costing, starting from operational micro levels of where costs are incurred in the labor, in buying the materials, in buying various services and how they're accumulated and they're attached to product. That's more of a activity-based approach to cost allocation and management. Then in the course, we actually go through and look at strategy-based approaches to responsibility accounting. That is where we start with the customer. Why are they buying our product? And then walk backwards with respect to what is the story of the organization. What is the story of value creation that leads the customer to buy the product or the service of the organization? And this is where we have led to now, where we're actually looking at, is there some measures out there, especially for large organizations, that accounting can be used to help either incentivize or align or motivate divisional managers to make sure that value is being created. So the big theme that I'm going to take you through in the next few slides is all about value creation and can accounting be used for that. So there's our two big pictures of previous sections of this course. All right, the bottom up, and then we've got the top down. So we're sort of still continuing this top down, but we're really focusing on large organizations. Let's get into the good stuff of financial responsibility centers. We've got summary performance measures within financial responsibility centers, and let's go to the next framework where this shows out. Here we have the new framework, and that's within financial responsibility centers. So this could be a cost center, it could be a revenue center, it could be a profit center, it could be an investment center. And we can choose to have summary measures, or we can choose to have a combination of measures. That is a combination of market measures, accounting measures, or non-financial measures. And we know all about these, don't we? Why? Because we did the balanced scorecard. We had a look at accounting for quality. We had a look at accounting for the theory of constraints, accounting for time. And that made us focus more on the operational day-to-day operations, where non-financial measures become more visible and were more important. But from month to month, quarter to quarter, we try and measure the economic movement of the organization in terms of its value creation, in terms of its balance sheet status. We measure that with accounting summary measures. So we can have market measures or accounting measures. They are summary measures, and that's what we're going to focus on in this section. Summary measures basically are a single number. They are an aggregate, and they're normally a bottom line financial measure of performance. They reflect the aggregate bottom line impacts of multiple performance areas. For example, accounting profits reflect the aggregate effects of both revenue and cost related decisions. There are two types, market measures and accounting measures. Normally market measures are the stock prices or the shareholder returns shareholders get from owning that share over time. Now, sometimes the value creation by the business and the value by the market can change from time to time. So for example, in 2015, the stock market values of companies is very, very high compared to the actual intrinsic value of the company. And because the market sentiment is very, very positive, the interest rates are very, very low, so institutions don't have any other place to put their money, so they throw it into the stock market, and share prices get much, much higher than what they would be on average relative to the intrinsic value of companies. So there's the value of the company operations, and then there's the value given to the company by the stock market. So sometimes that value given by the stock market is much lower than what the company's value is, maybe end of 2008 going into 2009, but now the last 3 or 4 years that value has started to get higher and higher and higher away from the intrinsic value of the company. So sometimes the value of the company's intrinsic value, its performance, is sometimes different from what the value is ascribed to that company by the share market. So just keep that in mind. Market measures can tend to distort the real value of a company depending on the psychology of the market, whether the market sentiment is positive or negative, which can change from year to year, from month to month, through the stock market cycles. There are accounting measures, and they are normally defined in either residual terms like net income after taxes, operating profit, residual income, economic value added, or in ratio terms, return on investment, return on equity, return on net assets. And this is what we're going to cover a little bit more detail in this section. We're going to look at return on investment or return on equity as measures of a divisional performance. So we have different market measures, but we want to evaluate market measures based on prescribed criteria, whether they are timely or not. And sometimes market measures may not change from day to day. They may take a longer time to reflect the true value of what is being transacted. Precise. Market measures can be precise in well-functioning capital markets. And objective. Well, they're not easily manipulable by the managers, okay, like stuff in the sales channels, or by delaying capital purchases. All right, the stock market may see through this from time to time, depending on how large and transparent the company is. Market measures are going to be congruent, the most direct manifestation or closest proxy of the theoretical notion of firm value. Okay, so those that ascribe to firm value as actually being that value that is determined by the stock market, then those people would say market measures are congruent with firm value. Market measures in some ways are cost effective. They do not require any company measurement or expense, because the stock market does the measurement. Okay. And market measures are understandable because it's reported in the press every day. People come to become familiar with what is a stock price, how to buy a stock, how to sell a stock. And so increasingly people in the Western world understand what a stock price is. Increasingly in the developing world also, market measures are understandable. So these are different criteria that say, well, market measures are very, very good. What about limitations? Well, sometimes there's congruence. Market measures are heavily influenced by future expectations, but these might not be realized. So therefore, when management do their conference call on the earnings report part of each quarter season, then a lot of questions that are asked by analysts, by media is, so what are your projections for the next quarter, for the next 6 months, for the next 12 months? People want to know the future because most market prices are kind of determined by what the future expectations are. And you buy something for the future expectations of getting a dividend, for the future expectations that that price will go up. So it's all about the future. So if there is any question about the future of a company, then the market value will heavily discount the current intrinsic value of the company. And so this is what we mean by the lack of congruence. All right. So market measures are really looking for the future cash flow of the company that's going to come in, brought about by its transfer of value to the customers of the company through products through services. Market values can be affected by carefully timed or managed disclosures. They're not always in the firm's long-term interest. And also there's market efficiency. Due to competitive sensitivities, markets are not always fully informed about a company's plans and prospects. That's why it's always better, if you don't have time to research a company, to focus on the big caps, because number one, they're more transparent. Number two, they have a greater institutional following, so therefore their beta compared to the market, that is the volatility of the big caps compared to the overall market, is going to be less than the volatility of the overall market, or closer to 1, the beta of 1. It means it's equal to the market. And so this may be a limitation. So the market efficiency of smaller firms may be much lower, and so therefore they'll tend to have a greater volatility. The share price will have a greater volatility with respect to the value of the organization. And for large firms, there'll be less volatility. So this is a possible limitation of a market measure. This limitation is going to be more transparent, especially for smaller organizations, for smaller firms. And so there are other anomalies too, all right? An example of that may be share prices tend to have a more negative response in terms of rainy days versus sunny days. There's some research out there in the finance literature that has found this. So little anomalies of the stock market that show that there's some kind of behavioral phenomenon entering into the value discovery process. More limitations: feasibility. They're not available to either for privately held firms or wholly owned subsidiaries or divisions, although there are private firms out there that we know the value of. Why? Because we can look at their latest venture capital rounds. For example, Xiaomi has a valuation of about $43 billion based on its last round of VC funding that was done several months ago. This is early 2015. But it's not on the stock market. How do we know that? Well, we find out how much capital was raised and how much share of the total shareholding pool of Xiaomi was actually given up for that VC funding. And you do the multiplication and you work out 43 billion market capitalization. Wow. Okay, so apart from that, it's very hard to get another valuation unless you use some kind of multiple like 10 times sales, something like that. These are always judgment calls because there's no market making device out there to say that your judgment of 10 times sales is the correct judgment of the value of the company you are looking at. It's not until the company lists on the share market and you get buyers and sellers with efficient knowledge of what they're buying and selling that a certain price can reflect the value of the organization. Controllability. Market measures can generally be affected to a significant extent by only the top few managers in an organization, those who have power to make decisions of major importance. So therefore, it's very hard to use a market measure as a bonus allocation device to a divisional manager of a division that has very little impact on the overall value of the company. Can you see that? So the market price may go up or down regardless of the decisions that a divisional manager may make. And so there's a kind of a disconnection. And it's very important when you use measures to allocate bonuses that you have some kind of connection between the control that a manager has over those measures, so therefore they can see the incentive of actually making the decisions they have to make, and the incentive is attached to getting a bonus as a result of making a good decision and not getting a bonus as a result of making a bad decision. So that connection, that's what we mean by controllability. How much control does a divisional manager have over the measure that is being used to allocate their bonus? So in summary, these limitations of market measures cause organizations to look for surrogate measures of performance. Accounting measures are the most important surrogates used, particularly at management levels below the very top of the firm. So as we get lower in the organization, divisional managers, their subordinates, maybe a country level manager or even a regional level manager, they may not have much impact on the final share price, but they may have more impact on the divisional profits, which is a summary measure that is defined by some accounting standard. Okay, so you make a sale, you earn revenue, you incur an expense, then there's a cost against that revenue, and that derives your profit. We put that profit over investments in that division. Now we get a return on investment. You see that? So this is what we mean by creating an accounting measure that is more likely to be controllable at the divisional level or just below the divisional level in the organization, when market measures are not so controllable. So now that we've started to talk about accounting measures, let's get into the good stuff, shall we? So now we've got accounting profits and returns. Now we know that these are going to be much more controllable because they are measures that are closer and more local to the divisional managers, to the various responsibility center managers that are taking actions. And you want bonuses that are going to be congruent or that are going to be controllable based on the good decisions that the managers make. And then the bonuses will have an impact on the manager's motivations to make the right decisions for the organization. So accounting profits are good because they can be measured in short time periods. And there is precision because accounting for a sale is accounting for a sale, and it's not manipulable directly. There are accounting rules out there that determine what is a revenue, what is a cost, what is an asset. And because there are these standard rules out there, there is precision. Another word for precision is reliability. That is, a dollar of sale that is measured last year means the same as a dollar of sale measured this year. Of course, there are inflation differences, but that is a separate issue. The actual measurement of that sale through the transaction is using the same phenomenon, okay? It's the same currency, okay? So you can actually compare year to year. You can compare it with a benchmark. You can compare one divisional manager in one country with a divisional manager's sales in another country after adjusting for currency differences. And so this is what we mean by precision. You're using accounting rules to generate that revenue, to generate that cost, to generate the value of the asset investment. It's objectivity. That means we can bring auditors into the division to double check that the sales recorded, that the costs recorded, that the investments recorded are correct and are consistent with the rules of the organization, with accounting reporting standard rules. And there is congruence. For profit firms, accounting profits or returns are relatively congruent with the true firm goal of maximizing shareholder value. And there are positive correlations between accounting profits and changes in stock prices. So there's kind of a linkage between having a higher profit, then maybe there might be a delay, 1 month, 2 months, 3 months, and that higher profit being linked to having a higher share price, because sometimes that linkage may be delayed because that accounting profit shows up internally and privately in month A, but it's not reported to the public until month C or D. Okay, but even when it does get reported, there is that linkage. So we can call that linkage congruence. And the great thing is that there you have a linkage between the accounting measure and the stock price, but also you have a linkage between the accounting measure and the actions that management take in their decisions, in how they manage the costs, in how they got out more sales, and how they promoted the product, and how they developed and innovated for new products, how they did all these things. They can see that there's a linkage between their actions and the accounting profit. So now we have a direct correspondence between manager actions to the profit to the market price. You see that? And so that's a good linkage to be able to show in terms of making sure that any bonuses that are attached to the accounting numbers has an incentive effect, okay, and has a motivational effect on the manager's actions. Okay, so we've got understandable, sometimes yes, sometimes no, and inexpensive. They are inexpensive because they're already in the accounting system. Once your company gets large enough, you need to have some accounting system for the purpose of auditing. Once a company is listed and has a earnings and has to have a report to shareholders, it must have an accounting system. The accounting system is not set up to incentivize management. The accounting system is set up for the purposes of just controlling the flow of money going into the company and money going out, just controlling the cash flow. Okay, and then the accounting system is also used maybe to support strategy. The accounting system is also used to actually report on the company's operations. The accounting system is used for many different functions, and because it's used for many different functions, it is there. It exists not because of just one function. So therefore, if you can put a system in your company that serves many different purposes, you would say that that system is quite efficient. You could say that, wow, that system is there for reporting to shareholders. Oh, let's use it to hold divisional managers, make them accountable for various operations we have given them responsibility over. We don't have to create a new number. We don't have to create a new measurement system. Why? The accounting system is already there. So that's what we mean by it's inexpensive. Okay, there are limitations. Accounting income does not reflect economic income perfectly because accounting measures, they are transactions orientated. They're dependent on the choice of measurement method. They are conservatively biased, and that means that they may underreport the actual value of the organization, and they ignore intangibles. Okay, so they may not reflect the full value of investment in research and development. They may not reflect the full value of investment in innovation, making a new design, making a new product, okay, or investing in brand development. You see, those investments are recorded, but they're recorded as a cost. But hopefully the company, by doing that, is trying to create 2 times, 3 times, 5 times, 10 times the value in terms of the final product or the new service or the actual added brand awareness of the company. You see that? So that's what we mean by it ignores the intangibles. It also ignores the cost of equity capital. It ignores risk, and it's a focus on the past, like historical measurement of assets. When we say that accounting does not reflect economic income perfectly, we're talking about the change in the value of the entity over a given period where value is obtained by discounting future cash flows. So keep that in mind. The system is closer to the decisions that divisional managers make. So therefore you can better hold them accountable for the profits, for the revenues, for the costs, for the investment they have control over. And so therefore you can attach a bonus to particular KPIs of the accounting numbers. So that's why accounting is good. You can do that. It's good because the system is already there. Because of these 2 reasons, we need to understand how accounting can be used as a KPI and the potential problems of its use as a KPI. Okay, here's the first big problem that exists when we start to use accounting measures. We get myopia. Now, what do we mean by myopia? It's the motivational effect of these measurement limitations can be perverse, because managers who are motivated to produce accounting profits and returns can, in the short term, do so by stuffing the sales channel. Okay, they can bring sales forward in from the next quarter into the current quarter. Okay, and so it looks as though that the company had a really good quarter this period, and then the following next period they don't have a good quarter, but by then the manager has left. They can do this by delaying the investment in different plant and equipment. How can they do that? We'll just say, well, let's just keep using the old one. Let's just keep on the maintenance of the old machines. We don't need to invest in a $10 million machine this quarter or this year. Hell, if we do this, then our return on investment will go down and I won't get my bonus. So this short-term thinking by managers can work against the long-term value creation of the organization. It works against the things that they should be doing on a monthly basis, on a quarterly basis, on a 6 monthly basis. And it's very easy to see that managers can do this. You're probably thinking, well, if they do this, they'll be caught out 1 year later, 2 years later, 3 years later, 4 years later. Well, guess what? In the S&P 500 companies, the average CEO tenure is only 3 years. That's average. So if we had a normal distribution, guess what? If 3 years in the average, wow, there are some CEO tenures that's only 1.5 years. There are some that's only 1 year. There's some that's only 6 months. Wow, that's real myopia. Okay, so if I just say 100 out of the Fortune 500 companies where the average CEO is less than 3 years, maybe it's just 1 year, 18 months. Wow, 18 months. Do you think they're going to think about the long-term value creation of the organization? No way. Okay, and this is what we mean by the problem of myopia. It's covered. It's really a output of the career concerns of the managers, the CEOs, that the fact that they're not going to be around for very long. Okay, so if managers are going to be around for 10 years, they're going to pay more attention to the value creation over 10 years. So this is what this page is all about. Myopia exists because managers are not around in the long term. All right, things are changing so fast, not just in Asia, but very, very fast in the USA too. So we've got investment myopia. We have operational myopia. I don't care if I peeve off my customers this quarter. I'm going to be gone in 6 months' time. That's not going to bother me. Okay, so you get these mindsets at play, especially when huge bonuses are attached to KPIs. And that KPI you have to meet is this quarter. You don't care about the KPI 6 months away. You're looking at the KPI in 3 months' time. So keep this in mind. Myopia means short-term sightedness. Okay, I normally have glasses. So I've got my glasses here. I usually put them on, but I only need it when I want to look far away. I don't need it for short term. Okay, I don't have myopia. Okay, but some people wear glasses because they can't see things close to them. All right, myopic vision. Yes, I think that's what it means. Okay, so let's move on to return on investment performance measures. So we got ROI. We have return on investment. That's the ratio of accounting profits earned by the business unit divided by the investment assigned to it. Return on investment equals profits divided by the investment base. Residual income, that is basically return on investment adjusted for a certain benchmark. So residual income is a dollar amount obtained by subtracting a capital charge from the reported accounting profit. So we're really focusing on the dollar value. Okay, here you're really focusing on a percentage value, and the residual income is much better than ROI, and I'm going to show you an example in the next section to demonstrate to you why it is better than return on investment as a KPI to make sure that managers focus on the long term for the value of the company as a whole. Return on investment is the most commonly used measure, however. It's easy to calculate, easy to understand, and meaningful in the absolute sense. All right, so there are various labels that we give. There is return on investment, return on equity, return on capital employed, return on net assets, and here we have the profit measure in the numerator. It can be fully allocated after tax profit measure or a before tax operating income measure. So whatever companies use, the most important thing is that they use it consistently. When they use it consistently, then they can compare one division with another division. Then they compare one division with the division performance in the previous period. The denominator can include all line items of assets and liabilities, including allocations of assets and liabilities, not directly controlled by the divisional manager. Or it can include only controllable assets, which include both receivables and inventories at a minimum. All right. So again, the denominator can be defined in many different ways. What's important is that it is consistently employed by the organization. The consistent employment of the formula enables comparison. The consistency enables comparison. Keep that in mind. However, there are problems caused by return on investment measures. The numerator, accounting profits, it includes all the problems associated with these profit measures, where managers may manipulate the profit. They may underreport expenses. They may push expenses out into the next period. They may bring revenues in from the next period. That's called stuffing the sales channel. The denominator, well, how do you measure the fixed assets portion? Do you revalue your assets, especially if you're in a country where there has been significant changes in inflation, like in South America or different countries in Eastern Europe from time to time? What do you do when you're in that situation? How to measure the fixed assets portion can be very questionable, and companies must have a consistent policy for how the fixed assets portion needs to be measured. Remember, consistency enables comparability. And there's sub-optimization. They can lead divisional managers to make decisions to improve division return on investment, even though the decisions are not in the corporation's best interest. Okay, so what I've taken you through now is basically various definitions and the context with what we are looking at return on investment as a summary accounting measure. And the whole purpose of taking you through these definitions is to get you to understand that there's no one way of measuring return on investment. What's important is that it's consistent. Okay. The other idea I want you to take away is that it's all about creating value. At the end of the day, we want to create value. We want to have some kind of measurement and controls in place so we can kind of generate that value. And we want to have a cheap system that enables us to measure that generational process. So accounting is already there. So why don't we use accounting to try and measure that value generation process? And so then once we have that measurement there, that helps to capture the decisions that are made to generate the value, then we can try and reward managers based on the decisions that they don't make. All right, so a value, there's some kind of value generating process. We want a cheap system, that's accounting, and now we can link the system to the value generation process by the use of some bonus, have some KPI with a bonus attached to the KPI. And the main KPI in this week is to look at return on investment and to look at residual income and compare the two and to understand how one may be superior or inferior to the other. So I'll catch you in the next section where we actually look at some examples to demonstrate when return on investment doesn't really work in the way it should work. See you in the next section, and thank you very much for watching. Bye.